Today's meditation is Leela March. Oh, that's all right. Good morning.
Good morning.
On Valentine's Day, 1990, 26 years ago, the Voyager 1 spacecraft left our planetary neighborhood for the fringes of the solar system. Carl Sagan asked that the engineers turn it around for one last look at its home planet, about 4 billion miles away. Caught in the center of scattered light rays, a result of taking the picture so close to the sun, Earth appears as a tiny point of light, a crescent only 0.12 pixels in size. This depiction of our home became known as the pale blue dot. I have it here, or you can Google it when you get home. I'm going to hand it to Margaret, and she's going to pass it. A few.
Well, not many are going to get it. There you go.
And this is what Carl Sagan had to say about it in his book of the same name. That's home. That's us. On it, everyone you love, everyone you know, everyone you ever heard of, every human being who ever was, lived out their lives. The aggregate of our joy and suffering, thousands of confident religions, ideologies, and economic doctrines, every hunter and forager, every hero and coward, every creator and destroyer of civilization, every king and peasant, every young couple in love, every mother and father, hopeful child, inventor and explorer, every teacher of morals, every corrupt politician, every superstar, every supreme leader, every saint and sinner in the history of our species lived there on a mote of dust suspended in a sunbeam. Let's meditate on that for a minute. Blessed be. This week's presentation is the psychology of investing. This is a fabulous, I just like the title. Making better financial decisions by understanding the way we think. It's presented by two people, Yann Kostic, MBA, and Tom Zachystal, CFA and CFP. A great deal of research has been done over the last few years on the topic of behavioral finance and how people make decisions with respect to their financial affairs. Understanding the biases that drive our decision-making can help us make better financial and life decisions and takes the stress out of financial planning for our future. So let's welcome our two presenters.
Check. Damas y caballeros, buenos días. Ladies and gentlemen, good morning. ¿Cómo están ustedes? Yes, Mariana? How are you this morning? Good? Okay, that's for the Spanish, I'm sorry, but that's about the body. First, we'd like to thank Open Circles for having us this morning. I think it's quite interesting that for the first time we're going to have something a little bit different. We talked about finance, but from that interesting, hey, don't start. I'm not doing it. And of course, we'd like to thank you for coming this morning. Hopefully, we'll make the presentation interesting. My name is Yann, and it's good to see some familiar faces this morning. For those of you who know me, even though I wear pants in the family, you all know that Gabby, my other half, is the boss at Four, the restaurant and music venue a couple of blocks away from here. So I do have a day job, I do work, and I happen to be an investment advisor and money manager. I've been doing that for about 15, 16 years now. But more important this morning, I have the pleasure to introduce you to my colleague and partner, Mr. Tom Zachystal. Tom is the owner of another financial planning and investment management firm in the Bay Area, and is the president-elect of the Financial Planning Association of San Francisco. You don't get there by accident. Tom is a very, very smart guy, and he knows exactly what he's talking about. Quick show of hands, how many US citizens or dual citizen people we have here this morning? Quite a few. They need to do a couple of legal stuff before we start, then have to do that. Tom and I both have dual citizenships. We're both registered advisors, and no, we are not stockbrokers, so we don't know about that stuff you were talking about. The big difference is we have a different set of rules as investment advisors. We have to abide by something that was done very recently in 1940, the Investment Advisor Act. We have to follow the F word. Everybody knows fiduciary, of course, what I'm talking about. So let me start with a little bit of background. For the longest time, people believed that markets, and specifically financial markets, were efficient. What does that mean exactly, efficient? Meaning that everybody, every one of us, and me, have access to the information at the same time, and that anyone can act upon it immediately, instantaneously, and that government is not involved and will not take a chunk of your money. I see people smiling. If you think about it for a second, I wonder why this was ever a theory. It just doesn't make sense. Some very smart people in academia, some PhD types, figured out, well, wait a minute. We already know that traits, bias, emotions affect people in their lives, in their relationships, in their careers. So could those traits affect us on how people treat their money and how they invest? Well, I've got a small hint for you. Actually, it does. Those traits are generally, the negative traits are generally affect us in life, and they affect us tremendously in our investment life. So, of course, with academia, you have to gather data, you have to do studies, you have to write papers, you have PhD thesis, and that's what we call today behavioral finance. Don't worry, it's Sunday, it's a beautiful day, it's too early. Not going to go there completely. I'm just going to give you the short of it. It turns out that most people's behavior actually is not efficient at all when we talk about investments. Now, I heard a couple of jokes. Now, I've got a joke of my own. Do you know how to make $1 million on Wall Street?
Start with 10.
You're a pro, you've been there. Actually, you start with 2, but apparently now you start with 10. The answer is you start with $2 million. But you said 10. I need to see you. Anyway, without further ado, here's Tom that is going to explore why our behaviors offer often counterproductive when we make decisions, life decisions, and investments.
Well, it's nice to be back in Ajijic. I've been coming down here for about 8 years. I have a number of clients here. I come down a couple of times a year, and It's raining and pouring in the Bay Area right now, snowing in the hills, and I came in last night. And it's always nice here, right? What is it, the second best climate in the world after someplace in Kenya, I think? So since everyone's telling jokes, I've got one too. First of all, I noticed that they nailed down the tip jars when we got here. But as Yann said, we're investment advisors, so we're not stockbrokers, see, so the light bulb joke. Investment advisors, traditionally the difference has been that brokers charge a commission and investment advisors charge an ongoing fee. And I say that because here's my joke. How many investment advisors does it take to screw in a light bulb as compared to stockbrokers? And the answer is one. Basically, he finds someone to screw the light bulb in, and then for the rest of your life, he charges you 1.5% a year to make sure it stays on. All right. So we're going to be talking about, as Yann said, behavioral finance. And what's interesting about this, I've done a lot of presentations in that room over there on financial topics. And this is going to be about finance, but it's going to be about how we make decisions in life as well. And we'll try to sort of give an example from the finance world and from the life world as we go along, right? And the biases and the way our brain works. And a lot of studies have been done on this because, frankly, the stuff you learn in textbooks, I'm a chartered financial analyst, the stuff we learn there, how to analyze stocks, how to set up portfolios, it works, but it doesn't work as well as it should. And people have learned over the years that really we're all human beings, and so a lot of the financial decisions people make and that the group of people makes are really based on emotion or other biases that we have. So let me start by saying this, and looking through the audience, about half of you are going to like this. Here's a statement. Men do worse than women, and single men do worse than married men when it comes to managing investments. That's a statistical fact. Anyone have any ideas on why that might be?
Women use both halves of their brain.
The men try to be very, very aggressive, and the more success they have, the more aggressive they become, and eventually they self-implode by being too aggressive.
What's your name?
David.
I didn't pay David to say that, because that's a great lead into what I'm going to talk about. He said men tend to be more aggressive, and if they have some success, they tend to make riskier bets as a result of that success. And overconfidence is exactly a big part of it. In fact, first of all, there are generally more men investors than women investors, and men, for whatever reason, tend to have overconfidence. And exactly, it's like this: if you have a sequence of successes, you make a few good bets, then your mind just naturally says, "Oh, I'm so good at this. I can make a riskier bet and make more money." And that's the way it manifests in the investment world. But to give you a really good example of how this works, has anyone seen the movie Boiler Room? Or do you know what a boiler room is? So the movie is about a group of people who are selling investments. And it's really a scam. But what they're doing is they have a phone, they have a list of people they're going to call that apparently have money. And they call them up. So here's a guy, he calls them up, and he says, I'm an investment advisor, I want to manage your money for you, but I know you don't know me, so I'm going to tell you a stock, and you can watch that stock for like a month and see what it does, and if I do well, maybe you'll consider my services. So the guy on the other line says, okay, whatever, fine, give me a stock. So he gives him a stock, it's a small company, very volatile, but a month later it's gone up by 30%, right? Calls him up a month later, he says, I'll prove it to you again, right? Gives him another stock. And he does this 4 or 5 times. Finally, the guy says, oh, you're amazing. 5 times in a row. How did you do this? How do you think he did it? Every time, he has 100 people. The first time he calls up 50, he says the stock's going to go up. The other 50, he says the stock's going to go down. Half of them are right. Then he calls up these 50. 25, he says the new stock's going to go up. 25, he says it's going to go down. 25 people are right. You see where I'm getting at? So that's how that scam works. But your brain also works that way, in a sense, because if you're right, and maybe it is because of skill, but it could be a fluke as well. So you need to really look at whether it is a fluke, and how you're making these decisions. And you shouldn't take on more risk just because you've been successful. You should maintain your level of risk, right? The other part that goes sort of hand in hand in that is the illusion of control. Which is another bias we have. So now you have the world of online trading, you can get a lot of information, and people naturally think the more information they get, the more in control they are that situation. So the more knowledge they have, so the better, the best they can have, right? But it's not so much how much knowledge you have, it's how you know how to interpret it and how relevant it is to your decisions as well, right? So generally, why do men do worse? Well, they trade more, which involves higher trading costs, and there's this certain aspect of making riskier bets if they're actually good at it. And another part of what goes along with that is also, the downside. We want to avoid the downside, which is called loss aversion, right? Yeah.
What happens is when things start to turn against you in real life, you tend to think, well, no, I'm not going to sell. No, let's take real estate. Most of you here own properties in Ajijic, but the price is going down. There's a crisis. Well, you're going to hold on to your house until the price goes back up. When the crisis hit in 2007, I used to live in Central Florida. And exactly. All those people, I said, hey, you know what, everybody's involved in real estate. Everybody was buying no money down type of scenario. And of course, we all know how this one ended up. I was in Miami at the time where there were 150,000 condos for sale. They were not even built yet. But they were turning around, and at the end, what happened is whoever ended up stuck with some piece of real estate, so don't worry, real estate always comes back. Well, in largely where he's from, San Francisco, New York, LA, yes, Chicago, those prices come up. Smaller places, I was living in smaller places in Florida, prices still to this day have not come back up. So what happens? You get stuck with that piece of property, even though you may lose, doesn't matter the amount, 100, 1,000, 100,000, and that prevents you from moving on in life. So a lot of cases, especially men, tend to not agree that they may have made a mistake for whatever reason and can't move on. It is very true. While women have more the tendency of being able to say, you know what, I'll take the loss because my priorities are different. My life is more important than my price. And that actually happens very often. We get stuck. You know what, the market is going to come back, I'm going to sell the house. Women tend to move forward better because they've got different objectives than men. So, in the investment experience, it's exactly the same. You buy a stock, whatever stock, or mutual fund, or whatever it is, and for some reason, the timing was wrong and the stock goes down. And, well, you keep it, no, it's going to go back up. And it's exactly the same story. You think if it's going to go back up in the future, but what happened is it depends, information keeps on changing. So you're anchored into that old information, and you're not paying attention to the new information. And people that got burned in the last two crises, in 01 and 07, 08, are spooked by the experience, so they're scared. It's exactly what happened in the people during the Great Depression era in the 30s in the States, and in Canada as well. People were very worried that this would come back again, always based on old information, not looking at what is the new stuff that is happening. So, Tom, the next part, the memory effect.
Yeah. So let's talk about an experiment that was done by a fellow named Daniel Kahneman, who I understand is a famous psychologist. And this was written up in the Journal of Psychological Science in 1993. And the title is, When More Pain is Preferred to Less, Adding a Better End. Okay, so here was the experiment, which was done on students. These experiments are always done on students because they'll do anything for a buck, right? So there's 2 buckets of ice water. And the student is asked, okay, put your right hand in this bucket here. They're both the same temperature. Put your right hand in this bucket, hold it there for 60 seconds. Okay, and then he takes it out. He says, okay, put your hand in this bucket, hold it there for 60 seconds, and then hold it there for another 30 seconds. And the last 30 seconds, the temperature raised by 1 degree. 1 degree doesn't make a big difference, but the temperature is raised by 1 degree. It gets a little bit warmer. The student isn't told that it's raised by 1 degree, but his brain and body can feel the difference. So 60 seconds, 60 seconds, and then an extra 30 seconds, 1 degree warmer. And then they wait a while, a few minutes, and they ask the student, if you had to repeat one of these experiments, the right hand or the left hand, which one would it be? Which one would you rather do? Okay, So you would think that you'd only want to have 60 seconds in here as compared to 90, right? Because 1 degree doesn't make a big difference. But no, 70% of the students chose the 90-second thing because they had that extra 30 seconds of a little bit more warmth, and your brain kind of processes that, right? And this is what's called, we call it memory effects, right? And the way this manifests, so basically what it is a sudden change, a shock, is something we remember right away. But something that goes on and is a bit longer and maybe gets a little bit better, we kind of tend to forget that. And you know, in the investment world, the way that manifests is that you have a sudden crash. And over the last year, we haven't had a crash, but we've had probably 3 or 4 times where the market has very suddenly gone down by 10%. I'm talking about the U.S. stock market, really. And so you get, you know, over a period of a week, maybe, right? So you get the sudden thing. But then you could also have a time where the market just kind of goes lower, 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 or your investments are going down, down, down. And you tend to kind of ignore that, right? But the sudden crash, you're awake, you're processing that, and maybe you make a decision based on that. And in life, the way that manifests as well is, like, for example, I'm 52 years old. When I was 40, I was 25 pounds lighter than I am now, okay? And I felt great, I guess. But that was, you know, that was my late 30s, say. So that was 15 years ago, and I don't really remember how great I felt there. You know, I don't feel too bad now. I can look at photos and I look a bit different. You know, my wife tells me I look a lot different. And then again, I had more hair too. So, but anyway, so over a period of time, yeah, I don't really remember what that's like. You know, I don't really feel the need to lose weight. Although, if I was thinking about how much I weighed there, I probably should lose some weight. But suppose that in a month or two, I put on 25 pounds. Has anyone seen the movie Super Size Me? Yeah, what's that about? It's about this guy who eats at McDonald's for a month, right? He eats 3 meals a day at McDonald's, and it's an experiment. And what's that? And every time they ask if he wants to be supersized, he has to say yes too, right? And I think he didn't even make it through the whole month, right? By the 20th or the 25th day, he was just feeling so hard. He put on a bunch of weight, and so, you know, huge difference there. Over 15 years, not much of a difference. And so what's important is with these memory effects, we need to have a baseline, and we need to kind of have a benchmark in the investment world, we would call it, but also a benchmark for life in terms of weight or your health or whatever it is, right? And so another thing that kind of, speaking about these baselines and numbers we remember, another sort of bias that we have is called an anchoring bias, right?
Yeah, for the weight loss and the hair loss. Being there on that. Yeah, it's something that should be addressed. Yes. Confirmation basis, anchoring bias. Impressions are very, very, very hard to shape because we have selective filters. We bring more attention to information that supports our opinion. You know, anyone here may have said, hey, I've known people for 20 years. If they are like this, if they look like this, which is the way they're going to react. So we very easily have preconceived opinions when we are encountering someone new or something new. And when we do our own research regarding investments or finance, we generally stick to what we want to see. It's easier for us to identify with something we already know, as opposed to discover something new. And in the absence of any solid information or any new information that convinces us, we're going to pretty much stay and stick to our own ways. I'll give you an example, example that is very well known these days. Everybody knows Apple, right? You all have Apple products, great company, actually wonderful company, far from where you live, in Silicon Valley. Everybody says Apple is great stuff, right? Made a lot of money with Apple. She bought it a few years ago. And Apple is still a great company, still has great Apple TV and so on and so forth. But if you look at Apple in the past 18 months, you've not made money with Apple. Last year, you actually most likely lost money with Apple. I mean, it's still a great company. If you go back and say, well, IBM is a great company, pretty much the same thing. Of course, those are great companies, and we know them. So we've all have grown up to know those companies, and we're more inclined to invest in something that we know, right? IBM, someone's got the great products, like all those great American and or Canadian companies for that matter. And sometimes that bias prevents us from looking for better opportunities. People that live here actually in Ajijic or in Mexico are somewhat different. And I think Tom will talk about this later on. We have a different, moving down here is a great experience, but obviously it's not for everyone. You have to have your mind quite open. When I told, people in the US, I lived in the US for 30 years. Today, I made up my mind. I came a couple of times to the area. I'm moving full-time to Mexico. People said, "Yeah, you're crazy. What's going on with all the crime? What are you going to do?" I said, "I've been there a couple of times, and yeah, some part of the countries are dangerous, but you know what? I've been to Puerto Vallarta, I've been to Manzanillo, I've been to Ajijic. The first time I was here was many, many years ago, 20 years ago. I said, this is heaven on earth. It's like California without Texas." And I lived in California for a year and a half, and taxes were my biggest, beautiful California is, problem were the taxes. And life down here is so, well, I don't have to tell you. You're here, so you're convinced. But we all know it's not for everyone. When you have newcomers, what do we tell them? Come here for a month, come here for a couple of months, see how it is. Maybe the next time come in the summer, see how it is in the summer. And then you can make a decision. Don't come and just buy a house and say, hey, and 2 years later, well, I don't like it. It's not what I expected. And my kids are going to go back to my kids. And that's what we put here. Met a lot of people, but beautiful property, you're going to be happy. No, I want to be close to my kids. Why didn't you think about this before? What is that new news that is coming to you that makes you change your mind? And the issue is, well, if you don't make large financial bets or investments, a house is also an investment, and a wise one, long term, that in 2 years don't go. You know what, I've eaten enough tacos that I won't go home, close to the kids. And now you got to put that house on the market, it seems to have changed, and put you, well, woman will sell a house. I'm moving out, sell a house. I don't care. First offer, I'll take it. Men won't do that. So, especially for people that are traveling around the world or settled expats, those decisions are extremely important because when we make a mistake, it's generally a very costly mistake. I'll go to one of those life examples. I've met a lot of people the past couple of years that when we talk about the price, the price when they moved on here, the pesos specifically. I said, well, the cost about, and he said, well, it's 500 pesos. He said, it's about for $40. No, it's not $40, it's much less than that. Price is changing all the time. But what I realized is people think of the pesos in terms of the price when they moved down here. And a lot of us change. So I want to put my money close to the area. I don't want to leave it like north. And they changed that 10, 12, 14. And I tell most people, you know what? Maybe that's not the smartest move in the world. You know what? The dollar is pretty strong currency. Now I know in Canada, loonie, I think we call it. It was very good 2 or 3 years ago. Now the dollar is so much higher that Canadians find everything expensive. Americans, not so much these days. Why? Because of course the dollar has moved so strongly. Because it's going to change. The trend is up there. But more importantly, people keep. And when I translate in pesos, I still have people. The other day someone said, 50, that's about $50. No, it's not. We're at 17.75. I think I didn't check Friday. But we get stuck in that old information and the price we pay. Now that influences us. If we have to sell that house or move money back to the US or Canada, the difference in price is no longer 14. So we have to keep aware of the new information that's coming to us, especially for our finances. So, yeah, I think now it's the next step will be,
I'm gonna tell you a story, and this is gonna be a story about a lady named Mary. It's gonna be a very short story, one paragraph, and then when I'm done, I'm gonna ask you what you think Mary does for a living, and there will be three choices. So the question I'm gonna ask you is, which of the three choices is most likely for occupation, okay? So I'll read this. Mary is quiet, studious, and very concerned with social issues. While an undergraduate at Berkeley, she majored in English literature and environmental studies. Her hobbies are reading and camping. Which of the following is most likely? That Mary is A, a librarian, B, a librarian and a member of the Sierra Club, or C, she works in the banking industry. Hang on. Mary is quiet, studious, and very concerned with social issues. While an undergraduate at Berkeley, she majored in English literature and environmental studies. Her hobbies are reading and camping. Which of the following is most likely? Who says librarian? Who says librarian and a member of the Sierra Club? Who says she works in the banking industry? Okay, so if you looked around, there were, I'd say, about as many people who picked B and C. So first of all, let me give you another little bit of information. There are about 170,000 librarians in the United States. There are about 1 million people working in the banking industry. You get what I'm getting at? It's much more likely she's in the banking industry, right? And then as far as being also a member of the Sierra Club, well, that's just a subset of being a librarian. I mean, if she's a librarian and a member of the Sierra Club, then she's already a librarian. But if she's a librarian, she's not necessarily a member of the Sierra Club, right? So it can't be B that's the most likely answer, right? And yet a lot of people, I'm looking around you, a lot of people pick B. Why? Because, I told you, she likes the environment, she's an English lit major, right? And this is the way our brain works. It takes shortcuts and it makes assumptions. And so this is called representativeness when we're talking about behavioral finance, right? And the way it manifests in the investment world, Yann already mentioned it, we may think that something is a good company, like Apple, but is that a good investment? You know, we have, and my wife works for Apple, I've got a lot of Apple products, right? So I love Apple, we have a lot of Apple stock. But the fact is that, and Apple has been a good company, and it's been a great investment for many years. But here's a company that's growing at, 20% a year. There's no way it's going to grow at 20% a year forever. There's no way it's going to grow at 10% a year forever. It's like, the Chinese economy. There's no way it's going to grow at 10% a year forever either, right? So just because it's been so it may continue to be a good company for many, many years. Although it's having some interesting times now. But it may continue to be a very good company for many years, but it won't necessarily be a good investment. And so in the investment world, it's important to understand why you're putting your money in it. Is it just because you've heard this is a great company? Is it just because you use the products? Or is it in fact a good investment? Another reason why it might not be a good investment is because the stock price has gone up so much and it's too expensive, right? In Apple, actually, it's kind of cheap by a lot of metrics right now. But Google, for example, is quite expensive compared to Apple. So it's important to understand, and there's a whole group of what we call socially responsible investing. Because a lot of people like to invest socially, right? And statistically, and you've got these exchange-traded funds, mutual funds that specialize in green investments, or there's no armaments, or you can do various investment screens for things that you're not interested in. And really, statistically, the socially responsible companies represented as a group do about average, right? And so it's very important to differentiate why you're investing in this. Is it because it's a good company, or is it in fact a good investment? And that also, you want to talk about familiarity, or should I move on here? I think you've already.
I think a lot of this, when compared, so many studies have been done.
Right?
Yeah. So many studies have been done. I mean, there's old-fashioned common sense, and the one that we can do, with all that. If I have to say one sentence or a couple of words, is penny wise, dollar foolish. We all know that expression, and we're all happy, guys, with Home Depot on Friday after Thanksgiving, well, no, starting your own Thanksgiving in the States, but we've got that power tool for 50% off. That feeling, that great feeling. I always wanted that drill. Women, I don't want to make a stereotype, but go for different items, two for one or three for one. We feel very good when we make a great deal. And most of the time, when the stock market goes up, we all feel good, right? Hey, those numbers change on that statement every month. We feel good, you feel good. When it starts to go down, you don't feel good. Like when you bought that driller, and it turns out that it's not that German brand or that US brand that works. It's made in China. After a month and a half, nothing against Chinese. After a month, it broke. So hopefully you bought it in Home Depot and they'll exchange it for you. But you know that feeling when you have such a good deal and you're proud of yourself. You know that little red dress. Couldn't afford not to buy it, right? And this is that feeling that you have when you make an investment. And the power is when numbers go up, you all feel good. When numbers go down, you all feel bad. And that this is where it's counterintuitive. Actually, when it comes down, great investors in this world, Warren Buffett and others, they're very happy when it goes down. Why? They buy more. So that I think is very important, and I think we're running out of time. There's a whole bunch of stuff we could talk about, but I think, like I said, we're running out of time. One thing that I've experienced here is I've met a lot of people that moved their money down from other places, from Europe, from Canada, from the United States. These were great local offers. Hey, you can make 4 or 5% on your money. Well, I'll take it anytime. Yeah, you bring it down here, it's in pesos. And then all of a sudden, all those risks, well, pesos don't stay up, didn't stay up. If you brought your money down a year or two ago, I don't have to tell you, you know already what the situation is. You have to go back and buy things in dollars, or in euros for that matter. So all that to say in the end that what feels good in life may work, but when we do investments, any kind of investments, we really have to be careful to not rely on old information, to really get the latest possible information, and to be very careful with our own emotions. For us, it's a little bit different. We don't look at emotions, we look at a situation, and it becomes obvious what we need to do, because we don't look at it with our own emotions. But if you do your own things, or your own investments, emotions are very much attached to it, and they can actually lead you to make the wrong decision because of emotions.
Yeah.
Good?
Well, I think we still have a little bit of time, right? And so let me tell you, because I like telling stories. I'll tell you a personal story. So I was an expat myself for 10 years. In a previous career, I was an engineer in the oil business. I worked for a company called Schlumberger, and I worked internationally for them in many parts of the world for about 10 years. And so I was young at the time. I worked, one of the places I worked was Nigeria, and I was there in my, I guess, late 20s. And so I fit into that category of people who like to make risky investments, male, single, young, you know. And a bunch of us in Nigeria funded this company that makes recreational submarines, okay? And they're built in California. Yeah, they're still alive. You can look at the website. I'll give you the website. It's a great product. You've probably seen it in National Geographic, Discovery Channel, whatever. So anyway, we funded this company, right? And as you can imagine, that's kind of a risky investment, right? And this was in 1995. And I did it sink, yeah. And no, it didn't sink. They're still alive. But nobody's made a dime. Okay, so I compare that to 1995, I believe, was when Google had their IPO. If I put all that money, and it was a significant chunk of change for me at the time, if I put all that money into Google, I probably would have done a lot better. But anyway, that's what I'm getting at is that another thing that kind of drives us in the investment world is this concept of anticipating rewards. And so, you know, we want to be rewarded. That's why we try new foods. That's why we salivate when we're thinking about chocolate or whatever we like, right? And making money is a reward, obviously. And so a lot of people will get into this risky behavior also because they have this anticipation of reward, especially if they've, or big money, or maybe something they just like doing. I mean, submarines is a cool idea, right? And another friend of mine, by the way, another engineer I worked with, he put he lost about, I think about $200,000 herding cattle over the Andes in South America. He was going to sell them in Argentina, and he came from Chile. So, and they froze. It was cold. But as an advisor, I've seen a lot of these risky investments, a lot more in the expat community than in the U.S., for example. And I've asked myself why that is. And I hear about people, not so much, Mexico is still a pretty civilized place, especially around here, but you go to some of the off-the-beaten-path places, Uruguay, for example, there are expat communities there as well. And you hear about people who take the position that maybe they've left the States and they're afraid about that the U.S. dollar is going to collapse and that the government may seize their 401ks and their IRAs, and so they're going to keep it safe. They're going to move all their money to a bank in Uruguay, right? And these are real stories. Or maybe they're going to invest in Uruguayan property, even though they know nothing about the property rights down there, right? They probably can't read the document it's printed on, and yet people do this, and usually there's some guy selling these investments there too, who's perceived as an expert, and so that's the way it goes, right? So I've often wondered, why do expats especially get into this extreme behavior? And I have a theory, I don't know if it's true, but I think we're kind of predisposed to it. Because when you think about it, it's a risky move, giving up your life in the States or in Canada, moving to Ajijic or moving to Uruguay or Ecuador, right? So with we have a predisposition to this kind of behavior. And so that means we have to watch it, right? We have to be careful that that doesn't, get us into trouble with investments or in life. And so just kind of in conclusion, I think now, yeah? Unless there's something else you want to say. So kind of, we've talked about a lot of these biases, right? And we don't have a solution. This is psychology. There's no solution, really. But what are the things to look for? So first of all, understanding the way we think is useful. And there are a number of books on the topic. I can mention one, for example. There's a guy called Dan Ariely, who's written on a number of these topics. He has a bunch of books out. One is called Predictably Irrational, available on iPads, as well as Kindle and everywhere else. So if you want to read up on that, that's a good book, I think. But understanding the biases. And then, at least in the investment world, maybe also with health issues, life issues, it's important to set objective benchmarks and to pay attention to them. How well are our investments actually doing? How compared to some kind of reasonable comparison. If you have half your money in bonds and half your money in stocks, you don't compare it all to the stock market, right? You have to pick some kind of a suitable benchmark to that, right? So the benchmark, paying attention to it, and paying attention to it the longer term too. Don't forget that over the 15 years you kind of tend to forget about it, right? And then if you have a certain risk profile, a lot of people here are older. Maybe you feel that you shouldn't take on as risky investments. Maybe you don't care, I don't know. But if you have a certain risk profile, making sure you don't get out of your comfort zone. Even if you've had some successes, don't put more money into that. And in the financial world, we control that, for example, through diversification or through rebalancing a portfolio if it gets out of whack a little bit. That's kind of how we look at it, right? And then quite often it's useful to seek a second opinion. In life, if you're a man, maybe you want to talk to your wife, who's a little bit more conservative, perhaps, or a doctor if you have some kind of a medical condition sneaking up on you. We tend to ignore those things sometimes, Or in the financial, you may even want to talk to a financial advisor. Who knows? But it's useful to get a second opinion, not because sometimes that person doesn't know any more than you do, but they can offer you a second opinion on it, sort of an objective opinion on it. I know my wife loves to offer me opinions on almost everything, so it's really well. And then finally, focus on what's important to you, and this is where it comes into in the financial planning domain rather than investment management, right? What are the goals? If the goals are not outliving your investment portfolio, that's your goal. Is it really outperforming the S&P 500, right? That's not the goal. Or if the goal is you want to travel a certain amount, then maybe you budget for that, So those are financial planning things. And also, it's important because the other thing about setting these goals is you kind of know where you're at, And then you can also, I run into people who have a lot of money, and they don't want to spend it because they're scared they're going to outlive it. And if they knew that even if they put that money in a mattress and got nothing on it, they would never outlive it, then maybe they'd have a lot more fun, right? So that's kind of what I wanted to say. And I don't know if you want to wrap up.
Well, I think that's, the wrap-up is going to be the Q&A.
Oh, okay. So yeah, there we go.
Thank you, thank you.
So we have some time for questions. We may run over a little bit. If you need to leave, if you leave as quietly as possible and get outside of the gates before you start talking, otherwise we get to hear what you say, and it could be interesting. We'd love it if you keep it to questions, and if you want to make comments, if you could, they'll hang around for a while afterwards and you can discuss things. But for this point, if we can get more information and knowledge from them, it'd be fabulous. So if you raise your hands when the mic comes to you, stand and hold the mic very close to you.
Yeah.
Okay.
Just before the question, we are very lucky to have come here for a whole week. We will make a presentation tomorrow, Monday, right here in La Sala, more intimate settings, and it will be about money management specifically for expats in Mexico and in other countries. And on Wednesday we have one specifically, we have more like a workshop specifically for women, because the way men and women view investment in life is totally different. And this will have one here, and we will have at 4 restaurants in the afternoon with a cocktail, specifically for women.
That's fabulous. Great, we can get more to you. Okay.
And a little disclaimer, so we're not psychologists, right? Speaking for my personally, this is stuff I've read. I haven't done these experiments, so I don't know if I'll be able to. But Kat, maybe you can answer some of the questions, right? So stay up here. Right.
So they wanted to know what time is these. So just get clear. So tomorrow here it is at
10 o'clock, 10 o'clock.
10 or 10:30? 10 o'clock, and then at number 4 it is the following day, Wednesday.
At 10 o'clock again here, and at 4 it will be at 4.
At 4 o'clock at 4?
4 at 4.
4 at 4. That's easy, Wednesday. Okay, back here first, Lou.
At one time, fear and greed were the dominant emotions or psychological reactions to the market. Now, that's when the market was understood. Now we have a new dimension. It's the global market and the impacts of the global market. So there's been no comment up to this point concerning the global market. And my take is, with commodity and stock markets running literally 24 hours a day around the world, it seems that when China burps, the U.S. stock market vomits. So please comment regarding the global market and its impacts.
You're pointing at me. Well, I think that's right. And so one of the things, we talk about diversification in a portfolio, and when we started talking about this, and this goes back to the efficient market theory, really, diversified, and I have people come to me, oh yeah, I have a diversified portfolio, U.S. large cap stocks, U.S. small cap stocks, U.S. value stocks, U.S. growth stocks, and all of these move up and down. And they say, oh yeah, I've got some international too. And you're right, over the years, these, many of these markets, especially the stock markets, have become better correlated, and generally speaking, international markets, especially if they're not denominated in U.S. dollars, are more volatile, because you also have the currency fluctuations, right? So if you're measuring it in U.S. dollars. So that's exactly right. It's a more connected world. Proper diversification means that you can't just go international and go to these various U.S. asset classes. You might as well put just all your money into an index fund. There are other categories you can use other asset classes you can use to diversify, but it's becoming much harder. And it becomes especially hard during a crisis, because then we say correlations turn to 1, and correlations are measured between -1 and 1. If it's -1, then when something goes up, something else goes down. Like stocks and bonds tend to be uncorrelated. But all these other stock markets, even around the world, when there's a crisis, they tend to be well correlated. They go to 1, they all go down together. But I will tell you one little thing that I've noticed. So people, when they're down here and you're spending your money in pesos, here's another reason why you should keep some money in dollars. Because what happens when there's a crisis to the US dollar? It goes up. everybody puts their money into U.S. treasuries. And so I've come down here, I talked to my clients, and we had the 2008 crisis, and obviously our portfolios went down, and I came down here and said, I'm really sorry, your portfolio's gone down. I said, we're not even worried about it. Are you kidding? The dollar exchange rate has gone way up. I'm up 10% on my portfolio if I'm spending it in pesos, right? So that's another interesting thing about maybe keeping some of your money in dollars if you're spending it in pesos or euros or something else.
Over here. Hang on, we're taking a question over here.
If you were to recommend a stock to buy tomorrow, what would it be?
I think you should buy Apple because I have a lot of Apple stock and I want it to go up. We're not doing that here today, but
No, you can't.
I just want to clarify the sessions at LCS this coming week. First of all, you have to be an LCS member. Secondly, you have to sign up at the office, and it is limited to, I don't remember, I think it's 40 people. So it quite possibly is full, but those two things certainly have to be.
Thanks for clarifying that. Appreciate that.
Hi, this is a Canadian question, but I was reading that the U.S. stock market, the Dow, has gone down 16% in every year that a president was in the 8th year of his term. What would you advise people to invest in with that sort of a scenario?
Sure. So I am Canadian, by the way. I grew up in Canada, and I've lived in California since '99, and we became a U.S. citizen last year, so I'm also a U.S. citizen. And I'm Czech. I was born in Prague, actually. So 3 citizenships. But anyway, so if you, by the way, have you heard that and I don't want to make any political comments, but Donald Trump is doing really well, and apparently after Super Tuesday there were a lot of inquiries about moving to Canada. But Mexico, maybe, yeah, but President Obama came up with something last week. He was doing a speech with Justin Trudeau, which is another interesting Canadian story because he is the son of a former prime minister back in the 80s who was famous for, he was kind of a ladies' man. But anyway, so he and Justin Trudeau were at the White House, and President Obama said that thing about, Trump and people moving to Canada. And here's what I like about Obama. He says, back when I was elected, I bet you there were people who wanted to move to Canada too. But anyway, so now I've forgotten the question.
Yeah, we're not here to make stock predictions or anything.
No, but it wasn't a stock prediction. Sorry, what was it?
We want to know what for Canada, what would be the
8th year, in the 8th year
president's
term,
yeah.
the stock market.
I'll be honest, I think this is like that story about if you do really well, how you take on more risk. I bet you if we measured the correlations between what actually happens in any presidential year and what the stock market does, it would be a fluke. I mean, I don't think it makes a big difference over the long term. I don't think that's the way to bet. I think there are better ways to manage investments than to bet on things like that. That's my opinion.
We have time for one more question, and then you can hang out afterwards and ask. Yep, I'm in the back.
How do we invest for stability in such volatile times?
Oh, wow, that's like a question. We're going to be talking about that tomorrow. Do you want to say something? Yeah.
Well, that question actually is not unrelated to the first question. We live in a global world. We cannot think anymore in just the terms of the U.S. economy or the Canadian economy or the Mexican economy for that matter. Last year, what they did, what you hear on the radio all the time, they wanted to privatize the oil industry that has been nationalized in the 30s. And then all of a sudden today, oil is at what fortune? It belonged to the Mexican people, and the government decided we're going to sell to foreign companies. Yeah, it looks horrible, the worst possible decision that could have been made last year, because now where you see oil is, and I don't think it's finished, but it's another story. So you have to take into consideration so many things. And living as expats, we already have the opening of living in a different country, under a different language, under different sets of circumstances. So the best bet is don't keep all your eggs in the same basket, whatever that basket may be. We're talking about negative interest rates. That should scare everybody here. A little bit here, a little bit there, and you balance it out. And then that's called being diversified.
Yeah.
Diversified in currencies, in stocks, in bonds, in international markets, geographically, politically. Really have a global point of view.
And let me just add, and maybe a good way to finish it off, is that this also comes into the domain of financial planning and knowing what your goals are, right? So take out the word investment and replace it by what are my goals? And so if you're really nervous about the market, and if you do a calculation, if I put my money in something that doesn't yield any interest, could I live for the rest of my life? You know, possibly yes, possibly no. But understand why you're investing, how much risk you're actually taking on, and what your goals are for that money, and and how much you can lose and still meet those goals. That, I think, gives people a lot of comfort, knowing how much they can lose and still meet their goals, whatever those are.
Thank you very much, everybody. Great wealth of information. You have more opportunity to be with them. Thank you all. Please turn your cell phones on if you so like. Please stack your chairs, pick up your coffee cups.